Home prices in China just posted their largest monthly decline since October 2014. And they did so in a month when the Chinese government announced its, quote, historic rescue. There is no sense in the marketplace or anywhere else that this has any chance of success. Just more band-aids being applied to increasingly gaping financial wounds. And you don't have to take my word for it. Take it from China's massive banking system that is scaling back financing activities in a way we've never seen before from the Chinese. Bank loan growth hit another record low, as did the growth rate for M2 money supply, which is a proxy for bank balance sheet activities. Meanwhile, China's central bank stepped up its warning, admonishing bond buyers that are seeking safety and liquidity that they'd better not bet against Xi Jinping. And bond buyers are doing so anyway. The Chinese also released their statistics on the economy, which again show just how much it is struggling due to the real estate drag combined with global weakness, and that Beijing is pretty much powerless to do much besides slowing and hopefully limiting the downside. There are widespread consequences to what's unfolding in China. For those around the world with direct exposure, and there's a lot more than you think, the chances of them taking losses are going way up with each monthly data point going way down. And the level of losses they'll end up getting stuck with goes way up too, especially with the slimming recoveries. Chances are unfortunately growing this becomes a disorderly unwind. What does the world's financial markets look like if China's housing bubble turns into something like their version of 2008? Now, the government is trying hard to avoid that, and so far they've been successful at keeping it at least moving along, but they've been completely unable to reverse it. So there is a growing downside reality unfolding right now, which raises the potential for a bigger and more chaotic slide. And it all begins with China's real estate woes. Despite a number of efforts that have been introduced into the real estate system over the last couple years, nothing seems to be working. If anything, and this is the real point, housing prices and therefore real estate problems continue to accelerate to the downside. According to the latest report from China's National Bureau of Statistics, the 70-city home price average fell by 0.7% or 0.7% month over month. That's just in the month of May alone. And that followed a 0.6% decline in April. Home prices were down in 68 out of those 70 cities, with the two exceptions being Taiwan and Shanghai. Year over year, the 70-city price average is down 4.3%, accelerating from a 3.1% year-over-year change last month. That's the worst year-over-year rate since June of 2015. And compared to last year, home prices are down in 67 out of the 70 cities. The only exceptions, of course, Shanghai, which is the top tier, as well as Chengdu and Xi'an. We even see major home price declines in major cities now, like Guangzhou, down 8.3% year over year. In Nanjing, for example, home prices are down 8.5% year over year. Even Beijing, the capital, which is considered one of the top tier cities, if not the top tier city, home prices there down 1.1% in May alone, bringing the index for Beijing down 1.8% year over year. So major slide in home prices in China that continues, not just continues, it is accelerating to the downside. And all the Chinese government has announced is that they're going to use the PBOC and maybe some bank funding to try to buy up a slim margin of unfinished properties to maybe reduce the supply enough that it helps stabilize the housing market. It's the stabilizing the housing market isn't happening, and the historic rescue, this repackaging of urban renewal, isn't winning any fans in the marketplace or the real economy. We'll see about the real economic fallout from it in just a moment. But in terms of financial fallout, the banking system, mortgage borrowers, mortgage lending, according to the statistics the PBOC released last week from its financial statistics report, household loans only increased by 75.7 billion yuan in the month of May. That's practically nothing. That followed a 522 billion yuan decrease in April. So put it together, January, February, March, April, and May, the first 5 months of this year, household loans, primarily mortgages, only increased by 889 billion. That is far less than the 2.3 trillion from January to May of last year and the nearly 3 trillion from January to May 2019, going back to before the pandemic. So just 890 billion this year compared to almost 3 trillion in 2019. That's a huge reduction, both in appetite for borrowing mortgages, therefore buying houses, as well as the proclivity of banks to issue mortgage loans because they're increasingly risk averse too, as we'll see in just a moment. But before we get to the rest of China's ugly credit environment and the economic fallout from it, I want to let you know we're going to do a webinar on June 30th, which is a Friday at 6:30 p.m. Eastern Time, which is launching our anniversary sale here at Eurodollar University. The webinar is going to focus on the fundamentals of interest rates over the next 12 months, what the fundamentals for rates are, what they might look like, and why they include keeping a very close eye on China. It's a synopsis of what I write every day at our deep dive analysis, the daily updates in my daily briefing, and behind both of those we have memberships with tons of background material. And you can sign up right now for our webinar on interest rate fundamentals. There's a link in the description, and I'll let you know about the details behind Eurodollar University's anniversary sale as we get closer to it. So sign up for the webinar, link in the description. I hope to see you there. Let's get back to China. In China's banking system and its financial fundamentals, the banks continue to scale back in their activities. While loan growth is still positive, it continues to come in at an accelerating downside rate or downside pace. The outstanding stock of overall loans in China, RMB local currency loans, was up 9.3% year over year in May, which is another new record low. And it's decelerating sharply ever since reopening failed last year. No matter what the government has done as far as quote unquote stimulus or trying to get banks more active in the real economy, the banking system continues to cut back, which means they're only giving out loans to only their best customers, which sounds a whole lot like the Western depressionary, deflationary world. So the banking system continues to set new record lows in RMB loan growth. M2 fell to 7.0% year over year in May. That's another new record low. It tells us something about what China's banking system is doing. It's a proxy for bank balance sheet behavior. Responding to all of this data, including the stuff we're going to get to as far as China's economy, mainstream in the West is starting to sound alarmed as well because they expect stimulus to work every time they assume it does. And it's becoming clearer and clearer that it is not working, especially in China's property sector. So here's how the mainstream responded to the latest developments. Activity in the closely watched real estate sector decelerated further in May, with development investment falling to a 2020 pace and prices of new homes plunging the most since late 2014, as I just said. Industrial production was also surprisingly weaker than expected. It's not so much a surprise. These figures come after several large-scale measures from the government to boost domestic demand. Most recently, officials announced $42 billion in funding for local governments to buy up excess inventory from developers. And that's after a slew of other measures in recent years, including easing mortgage rules and cutting down payment requirements. And it doesn't make any difference, which is the point. Because even the media has to account for the fact that they continue to do more and more in China and get less and less from it. In many respects, especially the property sector, it's not that they're getting less and less. The property sector and prices are going lower and lower and lower with no sign of stabilizing or even slowing down. As I said, as the data says, it's accelerating to the downside. And China's banks know it. And now the Western media actually knows it too. In addition to the bank lending report, the financial statistic report from the Chinese, they also published something called Aggregate Financing to the Real Economy, or Total Social Financing. And that was up a little bit in May of 2024 when compared to May of 2023. There was 2.07 trillion RMB in aggregate financing to the real economy, which is a broad measure of credit in all of its forms, not just loans, also government bond sales, equity sales, and a couple other items. But that's why AFRE was up in May of 2024 compared to May of 2023, was because of the launch of government bond sales last month. When we look at just RMB lending, again, bank loans, That came in at just 950 billion RMB in the month of May, which is an incredibly low total. And May is a pretty important month for real estate and lending overall. That compares to 1.4 trillion new RMB loans in May of 2023, so substantially lower than last year. It was 1.8 trillion in May of 2022 at the height of the post-pandemic frenzy. Again, slow down in the last 2 years. The downside of the supply shock has hit China and has hit Chinese banks the same way as it has everywhere else. The 950 billion in RMB loans in May of 2024 is also substantially less than the 1.2 trillion in May of 2019. And you've got to go all the way back to the bottom of Eurodollar number 3, the one that was focused and hit China squarely in the economy and its banking system, to see a similar RMB loan total as in last month. That was 937 billion in May of 2016. So basically May of 2024 in terms of China's new bank loans was May of 2016 levels. It's really emphatically describing how bad the situation is according to China's banks, despite, again, constant government pressure to help stabilize the situation. The banking system is saying we don't want anything to do with this. Without Chinese banks willing to extend credit, with these real estate woes that continue to get worse, with weak global demand, not strong global demand, with weak global demand, the combination of all of those things, it's understandable why China's economy continues to put up weaker and weaker numbers. Starting with fixed asset investment, real estate really having a major impact, and as I keep coming back to, accelerating to the downside over the last couple months. It's the reason why China's authorities are trying to step up what they're doing, even if it's not enough, because the situation appears to be moving in the wrong direction and maybe quite quickly. According to the latest numbers that were put out last night by the National Bureau of Statistics in China, fixed asset investment overall decelerated to a 4.0% accumulated rate. That's year to date, January through May, compared to January through May last year. According to the monthly numbers from the NBS, there's been 2 straight negative months for fixed asset investment and 3 out of the last 4, suggesting again there's a downside emerging, another further downside emerging in real estate and really across China's economy. Private fixed asset investment slowed down to just 0.1% accumulated. That's because there's more and more declines on a monthly basis, especially the last 2 months. Real estate development overall fell by a 10.1% accumulated year over year. Residential real estate construction and development down 10.6%. And here's what the NBS had to say about all of this. The newly started housing area was 300.9 million square meters, a decrease of 24.2%. That's year over year. Among them, the newly started residential area was 217.6 million square meters, a decrease of 25%. The completed housing area was 222.45 million square meters, a decrease of 20.1%. And among them, the completed residential area was 161.99 million square meters, a decrease of 19.8%. So as far as real estate goes, construction, related, financing, governments, bank loans, all of it, none of it's having any positive impact. And the evidence is piling up over the last several months. Everything is decelerating and accelerating to the downside. For the rest of China's statistics, industrial production, as the mainstream article mentioned earlier, they fell back to 5.6% year over year from 6.7% last year. So a slowdown in industrial production. So if China is dumping its excess production on the rest of the world, it's going to need to start ramping up production and dumping even more because internal demand just isn't keeping up, nor is external demand. We talked about that with exports. Exports look okay in dollar terms, but by volume, they're just not producing. There's not enough demand around the rest of the world to keep China's factories busy, and here we see the combination, weak internal problems and external problems together. Industrial production was up just 0.3% month over month, down from almost 1% in April, so slow down, a slide there as well. Retail sales, Chinese consumers continue to not spend, and can you blame them? When most household wealth is tied up in real estate and real estate accelerates to the downside, you're not going to get much spending out of Chinese consumers. Of course, that's nothing new either. Despite rounds of stimulus from Beijing, it's not having any impact on Chinese consumers. Retail sales were up just 3.7% year over year. That's a bit better than last month, which was 2.3% year over year, but not much has changed. 3.7, 2.3, there's really no difference there. It was up 4.7% when you exclude autos, because auto sales in China were down 4% compared to last year. So China's economy is suffering the fallout from the real estate woes. At the same time, it's getting pounded by a lack of external demand as well. Given everything here, it's not surprising China's yuan keeps hitting new lows. That's true today after the economic data was released last night. CNY down to about 725.61, which is a new low since last November. Despite the fact that the PBOC fixed the midpoint a little bit stronger than before, raising the chances that those two are going to come into collision. As far as China's bond markets, as I said in the introduction, interest rates continue to decline, though they've backed up a little bit here, a couple basis points at several maturities over the last couple days, as China's government continues to admonish bond buyers for buying bonds. It does not want them to seek safety and liquidity, because safety and liquidity is the opposite of what they're trying to advertise. According to Bloomberg, in another report late Friday, the newspaper affiliated with the central bank said investors are underestimating factors such as inflation that may upend the bond rally. The recent trend of money leaving bank deposits and flowing into asset management firms in search for higher returns will only temporarily boost demand for bonds, the central bank said. Well, the only reason they're buying central bank bonds is because they're looking for better returns in safety and liquidity. What the PBOC is basically saying: don't bet against our rescue. Don't bet against inflation reigniting once our genius plans start to bear fruit. Once we start having successes, you're not going to want to own safety and liquidity of government bonds. And bond buyers are saying that's what you say, but that's what you always say after every one of these plans comes out. And after every one of these plans comes out and is active for quite a while, it doesn't work. So owning safety and liquidity actually makes perfect sense. Even if the authorities are saying don't bet against Xi, all the markets are betting against Xi because all the data says that you should. Skepticism and pessimism is well founded and grounded in what's actually happening. China was supposed to be a huge contributor to global reflation this year in the same way reopening was last year. But instead, we see the real estate situation gets worse, and it's accelerating to the downside, getting worse, raising the prospects of a disorderly unwind. Authorities have been able to keep a lid on everything thus far, but the last couple months have not been encouraging. The banking system backs up that view 100%. The banks are cutting back on their activities, financing activities all over the economy, but especially where it comes to mortgages and real estate. The real economy in China is exhibiting the fallout from it, as you would expect once you realize the stimulus is ineffective. The situation is much, much bigger than people are prepared for. And the fallout was not going to be contained to just China and its economy and its banking system. Should it start to become even more of an issue, more of a downside, there'll be direct impacts across the financial system, more than there have been already, which haven't really been appreciated, as well as economic fallout downstream and upstream from China, the rest of Asia in particular. Authorities there have proven that they can't stop the bleeding, and that China is going to become more of a victim to and contribute even more toward the silent depression. Why is there so much pessimism and skepticism about China's historic housing rescue? Well, I took a look at the details in the video link below. As always, thank you very much for joining me. Check out Eurodollar University's webinar, link in the description. Thank you very much to Eurodollar University members and subscribers. And until next time, take care.